How's it going, everyone? My name is Dan, but you can call me Malone, and it's fair to say that buying a home will likely be the single biggest commitment of your cash that you make in your life. But more importantly, the mortgage that you sign will represent the biggest liability in your life. This is no small undertaking and therefore requires understanding. I see far too many people walking into mortgages just because they feel like it's the done thing, but they don't necessarily understand what it is they're signing themselves up for. And it's so important that each and every one of us is educated on the lending ecosystem here in Ireland. So today marks the first episode of my Irish mortgage series, where we're tackling some of the most common areas of confusion when it comes to mortgages in Ireland. In today's video, we're discussing what loan to value and loan to income ratios are and why they exist. But before we begin, if I could ask you to take 2 seconds out of your day to leave a like, and if you are new around here, don't forget to subscribe. Residential mortgages in Ireland are governed by what's known as macroprudential regulation. The objective of macroprudential regulation is to reduce the risk of the financial system suffering a major collapse or disruption. This was introduced in 2015 on the back of the global financial crisis of 2008. The regulations were introduced by the Central Bank of Ireland and led to the introduction of two key ratios, the loan to value ratio and the loan to income ratio. These were introduced to place limits on the size of a mortgage that a borrower could obtain relative to the value of the property and also relative to their own income. Let's first look at the loan to value ratio. The loan to value ratio is calculated by taking the value of the housing loan and dividing it by the value of the property purchased. So for example, if you bought a property worth €500,000 with a housing loan worth €300,000, then the loan to value ratio will be 60%. The maximum loan to value ratio which will apply to you as a borrower depends on what type of buyer you're classified as. There are three main classifications for buyers: first time buyer, non-first time buyer, and investor. The Central Bank of Ireland defines a first-time buyer as a borrower to whom no housing loan has ever before been advanced. Where the borrower under a housing loan is more than one person and one or more of those persons has previously been advanced a housing loan, none of those persons is a first-time buyer. What this means is that if you're a couple going for a mortgage and one of you previously had a housing loan, then neither of you will be classified as a first-time buyer. If you're classified as a first-time buyer, the maximum loan to value ratio you can obtain is 90%. So for a property valued at €500,000, a first-time buyer could obtain a mortgage up to €450,000 under the loan to value rules. It's worthwhile mentioning that many banks will offer you lower interest rates the lower your loan to value ratio is, and the rationale behind this is actually quite straightforward. If the value of the loan on your property is, say, 90% of the property's current market value, then a fall in housing prices of more than 10% would cause the home to fall into negative equity. Negative equity is where the value of the loans outstanding on the property exceeds the value of the property itself. So even if the bank repossessed and sold your home in the event of default, they wouldn't be able to recoup the total value of the loan outstanding. To account for this greater level of risk, the bank charges a higher interest rate. But say the value of the loan outstanding on the property is only 50% of the property's market value. In this case, property prices would have to fall by more than 50% for a negative equity scenario to arise. This gives the bank far greater protection in terms of their eventual repayment and reduces the overall risk profile of their balance sheet. Therefore, they can reflect this lower level of risk by charging lower interest rates, which decreases risk even further. The loan to income ratio concerns the principle of affordability. A key goal of any lending institution should be to ensure that the size of the loan that the borrower receives is affordable in consideration of their current and likely future earnings potential. Now, this wasn't necessarily the case pre-2008, where every Tom, Dick and Harry was being offered whatever loan they wanted. But when you think about it, a bank makes money from the interest that you pay on top of the capital repayments associated with the loan. So by offering you a loan that you can't afford, a bank will increase the level of risk that it holds on its balance sheet, because a higher cost to you as a borrower increases the likelihood of default. Loan defaults aren't good for the financial system as a whole, which goes back to why mortgages are governed by macroprudential regulation. In order to ensure that lending institutions were appropriately considering affordability in the context of the borrower, the Central Bank of Ireland introduced a maximum loan-to-income ratio of 3.5. What this means is that you can't obtain a housing loan that is greater than 3.5 times your gross income. So if your gross income is €40,000, the maximum housing loan that you can obtain is €140,000. €140,000 does not go a long way in the current housing market, which is why many single applicants are struggling to meet this requirement. But if you're buying a home with your partner, your gross incomes are combined for the purposes of the loan to income limit. So if you both have gross incomes of €40,000, well, now your maximum mortgage is €280,000. In addition to the loan to income ratio, the lender will also apply a net disposable income test. While the loan to income ratio determines how much of a housing loan you can obtain relative to your gross income, the net disposable income test ensures that you have a certain amount left over each month after your repayments have been made to survive at a reasonable standard of living. There's also a further requirement imposed on lenders to stress test your ability to make repayments. Because variable rate mortgages by nature have the ability to vary over time in terms of interest charged, lending institutions will assess your future affordability by looking at your repayment capacity if interest rates were to increase by 2%. So it's not enough to just demonstrate your repayment capacity today, you also need to demonstrate it in the future. It's worthwhile mentioning that lenders are given some degree of flexibility when it comes to loan to value and loan to income ratios. Lenders can breach the loan to value limits for first time buyers by up to 5% of the total value of loans advanced to first time buyers in a given year. This figure increases to 10% for investors and 20% for non-first time buyers. For the loan to income ratio, lenders can breach the 3.5 times limit for first-time buyers by up to 20% of the total value of loans advanced to first-time buyers in a given year. This figure decreases to 10% for non-first-time buyers. It's also important to note that the loan-to-income ratio does not apply to investors in residential property. These allowances are oftentimes referred to as exemptions. As crazy as this might sound, all of these regulations exist to protect you. The central bank does not want the people of Ireland to be exposed to excessively high levels of debt. That happened once before and they don't want it happening again. Likewise, they also don't want lending institutions to have excess risk on their balance sheet. The goal is to protect the overall stability of the financial system as a whole. But on the other hand, the regulations can't be too strict because that will impede the average Irish person's ability to purchase a home. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.